Hi everyone, it's Alex King here at Cestrin Capital Research. It's currently Monday the 6th of February, it's 5 o'clock Eastern for the benefit of the tape. Welcome everybody to our webinar for our Cestrin Tech Select newsletter members. This is a free webinar, anyone can join it, and hopefully many of you will join live as I see a number of people now stacking up, and also we'll make the recording available in the service. Very simple topic today, or simple question at any rate, hard thing to do, which is how to pick great tech stocks. There's many ways to do it, of course, but I thought what we could do is walk through some of the methods that we use. You've seen us talk about them in the newsletter, but also we're always keen to share the methods we use so that our members can use it in their own work. Housekeeping today, we're going to run through a disclaimer in a moment, and then all our webinars. So if you join them with any of our other services, you'll know, but if not, the services, the website webinar services we run on the pro tier of this newsletter or in our real-time services, we run on an open mic basis. So what that means is we unmute everybody. If you have a point to raise, question, comment, something you agree with, disagree with, anything you like, just shout into the system. And we're always really happy to encourage discussion, take questions, whatever you want to do. It's really a powerful part of the service that we offer. Our members love it. We really like it. It's a great part of the work. And if you can't use audio or you don't care to, then you can always use the chat function in the webinar system here. There's a chat box available to you, and there's also a question function that you can post. It's a little bit steam powered, but it does work. And if you're watching this on a recording, then by all means post comments to the article where we've included the recording, and we can pick them up there and answer them there. Okay, so without further ado, we'll move on to our disclaimer, which I'm going to read out for the benefit of the recording. So, disclaimer, this webinar is intended for US recipients only, and in particular is not directed at nor intended to be relied upon by any UK recipients. Any information or analysis in this webinar is not an offer to sell or the solicitation of an offer to buy any securities. Nothing in this webinar is intended to be investment advice, nor should it be relied upon to make investment decisions. Cestrin Capital Research, its employees, agents, or affiliates, including the presenter of this webinar or related persons, may have a position in any stocks, securities, or financial instruments referenced in the webinar. Any opinions, analyses, or probabilities expressed in the webinar are those of the presenter as of the webinar's date of transmission and are subject to change without notice. Companies referenced in the webinar or their employees or affiliates may be customers of Cestrin Capital Research. Cestrin Capital Research values both its independence and transparency and does not believe this presents a material potential conflict of interest or impacts the content of its research or publications. Okay, so just back to our agenda. So the topic is how to pick great tech stocks, and this is going to be our take on how we go about it. So we're going to look at underlying company metrics, that's financial fundamentals. We're going to look at how to time entries, stock entries, and how to time exits, stock exits. Again, many ways to do this, many ways to be successful at it. We're just going to walk through the methods that we use so that you can use them in your own work. Okay, so before we start, just a little bit about us, because many of you here are new to us. So we're an unusual kind of business. First of all, we're SEC regulated. That was by choice. So we're serious about what we do. You know, we're not just posting stuff on Twitter, shooting from the hip type of thing. We're a grown-up, proper, serious business. We have compliance procedures, all of that sort of thing. And all we do is investment research. So all of our revenue comes from publication revenues and from subscriptions. So 90+% of our revenue is subscription revenue. We're 100% online. All we do is publish on the internet, and we're an entirely distributed business. So all of our authors, and we have many of them, work to produce stuff for us on various topics, but we're not centralized in any way. Built in the modern idiom, people live all around the world. The founder, that's myself, Alex. My DNA as an investor is 3 decades of technology investing. I started out in venture capital, moved on to leverage buyouts. When I finished that and started investing my own money, that's in the public markets. Strong compliance culture we've talked about. So my fellow director, Wes Nissen, is a senior securities lawyer in a major Chicago law firm. And then we recruit our authors from around the world based on their skill. Fundamental analysis, technical analysis, macro insight, options, whatever it might be. All of that comes together in our subscription services. You can see our website, cestrincapitalresearch.com, for more. We run a range of services that run from a couple $100 a year for this TechSelect newsletter, the premium version, up to $8,000 a year for our premium institutional service. So you can take a look on our site. Okay, so what we do in our business is we cover a lot of stocks, a lot of technology stocks, probably about 50 or 60 stocks altogether, in addition to a bunch of value names, ETFs, indices, and so on and so forth. And we maintain a core database of the stocks, the prices, keep the chart updated. We follow the earnings every quarter. The earnings come out and analyze them, write them up, update our models, and so on and so forth. And we then pass up the content, and in this TechSelect newsletter, we pick selected tech stocks and report back on them. For those of you who are premium subscribers, you'll see in your inbox today a quick review of where the NASDAQ is headed in our view for this year and next year, and the impact of big tech earnings on that. So that's in your inbox right now. Let's step on to fundamental company analysis. This is the bare bones of what we do. So we believe there are sort of three elements to picking a good tech stock. Number one is the macro environment, and we'll come on to that in a moment. Number two is a fundamental company analysis. And remember, the company is not the stock. It's a completely different thing. But the stock is issued by the company, and it has some relationship to the company. So it's good to know things about the company itself. And then the final thing is the technical performance, the stock chart performance, for want of a better word, of the stock itself as an independent entity, as if it were unrelated to the company. So we break our analysis up into macro, fundamental, and technical. I'm not talking about macro too much here, but I would observe one thing, which is for tech stocks, one thing that's really important is to understand the direction of monetary policy. It doesn't really matter what the prevailing Fed funds rate is. It doesn't really matter what the inflation rate is. What matters is what's the direction of travel. Are rates and inflation coming down or up? Generally speaking, because technology stocks are perceived to be higher risk, and you can argue about whether they are or they aren't, but they're perceived to be higher risk. So generally speaking, when rates are climbing, tech stocks tend to sell off. And the reason for that isn't because they need to borrow money, some do, but most don't. The reason is because as money gets more expensive, investors look for safer and safer and safer homes if they're going to put their money not in cash. And because tech is perceived to be riskier, the more expensive money gets, the less money tends to be weighted towards tech, roughly. If monetary policy is easing, as in rates are on the way down or expected to be on the way down, if inflation is reducing or expected to be reducing, generally speaking, tech will go up. Again, in your inbox now, for those of you who are premium subscriber, you'll see some discussion of this as regards 2019, 2020, 21, 22. But in essence, in 2018, the Fed was tightening monetary policy, and it was a really tough year for tech stocks, flat on the year at best. 2019, monetary policy is a little bit. We're not talking about COVID stimulus here. We're just talking about ceasing raising rates, and the Nasdaq was up by around 50% in 2019, not because of earnings, just because of monetary policy. 2021, as we know, huge federal stimulus, Nasdaq up, and 22, as we know, rates increased, inflation up, and tech down. In 23 so far, probably we're seeing some slowing of the rate at which base rates rise. It's possible we see rates level off, and it's possible that rates come down, if not this year, then next year. And so that's a pretty positive backdrop against which tech stocks have to perform. So house expectation is that the next year or two is a pretty good place to be in tech, as opposed to 22, which is a pretty tough place. Okay, so that's macro, and obviously you can go into huge depth on this, but for our purposes, the backdrop right now we believe is supportive of being in tech. It's at least neutral, and it may become positive. Let's move on to fundamental company analysis. So there's a little table here of what good looks like according to various different lines here. Here's what we look at. So we look at revenue, we look at gross margins, we look at cash flow margins, we look at the balance sheet, and we look at the valuation. So let's just run through each of these. Revenue it is obviously really important. It's many times people misunderstand revenue. Revenue isn't sales. If you sell a 3-year contract that's worth, you know, $1 million, then you haven't got $1 million of revenue. If you sell a 3-year contract, which is to be split up equally over 3 years, then in year 1, you've got $250,000 of revenue. Year 2, $250,000. Year 3, $250,000, all based on US GAAP revenue recognition. Revenue we look at tells us, you know, what's the high level value that the company is delivering to its customers. That's what revenue measures, not sales. Sales you'll see elsewhere in subscription businesses. It pops up in remaining performance obligation, deferred revenue, all sorts of other things. Revenue is the rate at which value is being delivered to customers. That's the accounting measure. And what we're looking for in the stocks that we cover is growing, predictable revenues. So what does that mean? Well, in a subscription software company, you ought to be able to predict the revenue outcome to a reasonable degree, not perfectly, of course, but if, you know, 80% of the revenue is subscription, and you can look at the order book, the remaining performance obligation that you see is referred to in our work, and you can see that that's a big percentage of trailing 12-month revenue, and it's growing quickly as revenue, you can be reasonably confident that revenue growth is going to hold up. Now, in technology, growth matters, right? The rate of growth matters, and the predictability of growth matters. So what great looks like for us is high growth, that's, you know, minimum 20-30% revenue growth, and predictable. In other words, the majority of the revenue is subscription, and you can see that because the order book, the RPO balance is stocking up ahead of time, you can see that that revenue is going to keep growing. Gross margin. Okay, gross margin is revenue minus variable costs, and variable costs are any costs that are required in order to achieve the revenue. So for instance, sales commissions are a variable cost. For instance, any variable hosting fees that only exist if you sell a new instance of a software subscription, that will be a variable cost. We're looking for gross margins that are high on an absolute basis. So for software companies, you really want to see gross margins well in excess of 70%, and ideally in the 80s. Chip companies are going to be less. So best in class is probably Taiwan Semiconductor, which is mid-60s gross margin right now. Intel just put in a dreadful quarter down to 37% gross margin. So in software, north of 70, anything above 90, there's probably something odd with the accounting, so I wouldn't particularly believe that. And in semiconductors, then, you know, between 50 and 65, 70%, you know, is good. Once you get to that higher end of the range in semiconductors, it probably means you're at the high end of a margin cycle, so there's risk there. And as you can see, we go industry by industry. So if you're going to compare gross margin performance, you need to compare it with where was the company last quarter and last year and 3 years ago, just in and of itself, and then compare it to other similar business model stocks. There's no point comparing Intel to Salesforce. There's no point comparing Datadog to TSMC. They're completely different businesses. But you can compare Datadog to Splunk, or Datadog to Dynatrace, or Intel to TSMC. You can compare like with like. The next thing we look at is, it's not EPS. We never bother with EPS. Earnings per share can be manipulated by the share count, by what counts as earnings and what doesn't. We look at cash flow. And very specifically, we look at the unlevered pre-tax free cash flow margin. And that is a simple measure of cash flow. A very quick way to get to it, if you're looking through company accounts, is if you take the operating cash flow that you'll see reported, and you deduct CapEx, which you'll find as under investing cash flows. We get it a slightly different way, as you'll see in our notes, and we get to a slightly different number as a result. But that's a good shortcut, which is look at operating cash flow and deduct CapEx. And the reason that we look at that is it tells you what's the cash margins that the business is actually producing. And so that means, you know, everyone goes to work every day, comes home, and at the end of the day, what cash has been produced before the company pays for its capital structure, before it pays the IRS. What I mean by capital structure is, if it pays a dividend, then before the company pays any dividends out. If it's leveraged, before it pays any debt service or principal repayments. Those are capital structure incurred costs. And then tax. Tax is also a function of capital structure. So the more debt you have, the less tax you pay broadly, up to a limit. And so unlevered pre-tax free cash flow margins looks at the actual money the actual business produces. And if you divide that by revenue, then you've got a good measure of, well, how cash efficient is this business? And again, if you look within software companies and then within chip companies, you'll see that the best of them really do generate a very high cash flow margin. So you'll see in software, for instance, CrowdStrike, CRWD, is a combination of really high revenue growth and very high cash flow margins. That's pretty unusual. Datadog, similar. Dynatrace, not quite such high margin, not quite such high growth, but really solid business. And you'll see it at TSMC as well, high cash flow margins and high revenue growth. So that's really important to us, and it's unusual amongst equity analyst services to look at this. But we believe it's telling you the reality of the business, not the EPS that the CFO wants you to focus on, not the EPS that sell-side analysts are picking up, but the actuality of the business. Balance sheet. Balance sheet, as you know, is a way to record the financial position of the business, the snapshot financial position of the business. And we use a summary method in our work. As you'll have seen, we look at the net debt measure. Now, net debt may be positive, in which case it has a excess of debt over cash, or it may be negative, in which case an excess of cash over debt. And obviously it's better to have excess cash than debt, but a decent level of leverage is fine. It's nothing to worry about. With a cash generative business, it's no stress. So if you were to look at Dynatrace DT, for instance, you would see that when it IPO'd, it joined the market with, from memory, around 3 times leverage, which is 3 times debt. 3 times is the answer if you divide net debt by TTM EBITDA. And it's now moving into a net cash position, as it's generated so much cash flow that it's redeemed about $1 billion worth of leverage loans since it went public. And that's what good looks like. Another what good looks like is companies that raised a wall of cash at IPO, and even if they've been cash negative post IPO, they've just got billions sat in liquid cash in the bank. And an example of that would be Cloudflare, NET, which it's very cash consumptive, and they do have a little debt, but they have plenty of liquid cash because of the huge raise at IPO and also the subsequent convertible debt raise. Valuation. And what we mean by this is the valuation multiple. So that would be the trailing 12-month revenue multiple, or EBITDA multiple, or cash flow multiple. So if you're buying a stock, you ideally you want these multiples to be low versus the stock's own history and versus the growth rate of the business. Ideally revenue growth rate, to be honest with these things. You'll see many people talk about the earnings growth rate versus the PE, and that's good. But for tech stocks, generally, you should be looking at the revenue growth rate versus the revenue multiple, and then solve for the margins in other ways by the measures we've talked about, understanding the cash flow properly. So at entry, ideally, you want to be looking at low multiples, and then at exit, one of the things that should be causing you to think about selling a stock is that the valuation has gotten silly. It's a big multiple of trailing revenue versus the revenue growth, that sort of thing. So this is a whistle-stop tour, but if you're going to be doing fundamental company analysis, for us, this is what good looks like. Now, before I move on, I'm just going to make sure if anyone has any questions at all, now's a great time to shout out. I'm just going to make sure everyone's unmuted my side, which you are. So anyone has anything, now's a great time to ask. Okay, let's move on. I want to walk through an example here, which is a company called The Trade Desk. Ticker is TTD. And this is a software and services company. Many of you will be familiar with it. It's an ad tech business. It sits between brand owners, advertisers, and electronic real estate owners. So that could be connected TV, could be websites, but very specifically open internet situations, not walled gardens like Facebook or TikTok, but open internet. it's a fantastic business. It's now a decent sized business. In the September quarter, which is most recently reported, it had about $1.5 billion of trailing 12-month revenue. That was growing at 32% a year. And you can see here, it didn't really slow much in 22, which good indicator of the health of the economy, to be honest. You hear all this stuff about, it's going to be a terrible recession, but usually in a terrible recession, ad spend plummets, and if ad spend plummets, then TTD's revenue is going to plummet. Well, it didn't. So the most recent quarter, we had 31% revenue growth. In the June quarter, 35, March quarter, 43, and so you've seen the growth rates trim a bit, but not that much. So still 32% trailing 12-month revenue growth in the September quarter. Gross margins really high at 82%, and that's climbed nicely over the last few years. If you look back 3 years, September 19 quarter was at 76% on a trailing 12-month basis. If we then look at, we use EBITDA, you can use operating margins, but we like to use EBITDA. It solves for the heavy stock-based comp that you see in these companies, so we back that out. We also add back depreciation and amortization, not typically all that big a number in tech stocks, but this gives us an accounting measure of profitability. It's different to cash flow, as we'll see in a moment, but the accounting measure here is really strong. So trailing 12-month EBITDA margin is 41%. And that's for a business growing revenue at 32%. So that's good. That's really good. We then look to unlevered pre-tax free cash flow. Now, again, I mentioned a quick way you can get there, which is just take the operating cash flow and deduct CapEx. We go a slightly different route, which is we take the EBITDA number, deduct CapEx, and deduct something called change in working capital. So CapEx in TTD it's not nothing. It's averages 5-ish% of revenue. It was $25 million the most recent quarter. Change in working capital is, in essence, the difference between the rate at which you get paid by your customers and the rate at which you pay out your suppliers. And so if you get paid up front and you pay out your suppliers slowly, then this change in net working capital number here will be positive, black number. And if it's negative, you're paying suppliers fast and you're getting paid, it'll be a negative red number. I've oversimplified, but that's not a bad simplification. You can see, if you care to go looking, you can see on company balance sheets, you'll see a section in the balance sheet called changes in, in company cash flow statements called changes in operating assets and liabilities. Add all that up and you get the change in working capital for the quarter or for the year or whatever the period is that you're looking at. TTD has an unlevered pre-tax free cash flow margin of 33% on revenue growth of 32%. That's tremendous, right? So you have a company that's growing at 30% a year and spitting out over 30% cash flow margins. That really is excellent. And then we have a summary balance sheet here. There's no debt, and there's $1.3 billion of cash and equivalents and short-term marketable securities, which for a company like this will typically be treasury bills or certificates of deposit, something that's relatively easily turned into cash. So this is what good looks like in fundamentals. That's the trade desk TTD. Now, for disclosure, I own TTD personally, but this is what good looks like. Okay, before we move on to stock timing, entry and exit, anyone have any questions on that? If so, do shout. Many folks here have not attended our webinars before. We have a very simple rule for webinars, which is there's no such thing as a dumb question. All of my experience as a professional investor is that the best question in the room always comes from someone who thinks it's a dumb question, who doesn't want to ask the question, thinks they'll look an idiot, doesn't think they know what they're talking about, all the rest of it. Those are the best questions. So if you have anything to ask, please, please, please don't be shy, do shout. And if you don't like to shout publicly on the system, then post a comment in the recording article later on. Okay, let's move on. So before we move into chart analysis per se, I'd like to look at timing of entries and exits. And again, there's 101 different ways to do this, and I wouldn't for a moment claim that we have any kind of Oracle level status on this. We don't. What we do have is a system that works pretty well. We use this is for longer term investments. If you're trading short term, this is not really relevant, but for longer term investments where people often struggle to know, well, when do I buy? What does a sell off look like? What does a top look like? How do I know when to buy and sell? And we solve it in two ways. some technical chart stuff that I'll come on to in a moment. But we also use this motif, if you like. It's called the Wyckoff cycle. Now, this is an idealized way of looking at stocks, but the more liquid stocks do tend to behave like this, and they behave like this because this is how you make money if you're a big account player. And I don't mean, you know, even a hedge fund. I mean a big, large insurance company that can't do fancy things with derivatives, can't use leverage, all those things, and just has to make money by the movement of stock and bond prices. And the way they make money with these things is they use their weight of capital to move the stock around. Now, we'll come on to what this looks like on a stock chart later, but in the idealized form here, you'll see these several phases of stock price evolution. So on the bottom left here, we have what's known as the accumulation period. So this is a point at which a stock may be going sideways at a relatively low level, and it may oscillate, you know, within that range, as you can see there in that green box in the lower left of the screen. And at this point, you'll see pretty heavy volume within this price range, and very often that looks that's institutional accumulation. If you're a big insurance company and you spent your time quietly buying this stuff, being really careful, if the stock starts to run away, you may sell a bit, let the stock come down again. If it goes too low, you may buy a bit, let the stock come up a bit. You're carefully accumulating, just adding a bit on a bad day, trimming a bit on a good day, adding a bit more on a bad day, just building that up snowball style. At some point, that story is going to break, and either because, you know, you happen to leave the door open at home when you're on a work call and you've got a bunch of people around the house and they happen to overhear what you're doing in your office. I'm sure that never happens, but, you know, were that to happen, that would be one way for the story to break, you know, or you have a bunch of sell-side analysts start to pick up the story and write up the stock or whatever it might be, but the story will often break, and you then enter the markup phase. Markup is when late buyers come in. Now, late buyers come in two forms. Number one, momentum hedge funds. This is a good strategy if you know what you're doing. It's difficult, but if you know what you're doing, it's really smart. So a momentum-based fund will you have usually a leverage fund, so they'll be borrowing money to amplify the fund size, and their method will be buy high and sell higher. Sounds silly, but it isn't. You just have to know what you're doing. So they'll buy as a run-up starts, and they'll sell as it peters out. And they make mistakes, of course, but you know, you can do that repeatedly as a strategy. That's a good kind of late buyer, usually a successful late buyer. A bad kind is retail. So usually towards the top of this markup zone is when retail will be getting all excited about a stock, because it's been going up forever. It's going to clearly go to the moon. It's never going to come down again. It's all over CNBC. You know, everyone's talking about it. You know, it's all over Twitter. And at that point, retail FOMO will kick in and people will start buying it, which is just in time for the stock to enter this distribution zone in red at the top here. So this is where you'll see a stock again start to move sideways over a period of time. And that period of time might be a week, a month, it can be a year, depending on how big the holdings are of institutions and, you know, just how big those institutions are. So if you see a stock moving sideways at what's obviously a high point, you can be reasonably certain that's institutional distribution, selling. And they'll do the opposite of accumulation. On a bright green day, they'll sell some. On a really red day, they might buy a little bit just to disguise that distribution cycle. They'll always be selling a bit more than they're buying. And over a period of time, weeks, months, a year, sometimes more than a year, you'll see institutions drip out of that stock. And you'll see everyone on Twitter, retail, talking about it's going to be a breakout. It's going to be a breakout. It's just staging for a run. Blah 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 blah. Oops. What happens next is markdown. Now, markdown, there's no volume buyers left. Okay, so your institutional owner has sold out either entirely or sold out the degree that they want to. There's no volume buyers left, so the stock just slides. You'll then get momentum hedge funds coming in on the other side. They'll be short the stock, and again, you can do that successfully. And you'll see retail going, oh, I thought this was going to be a moonshot. You know, it's going down, I'm out. Hence markdown. So markup, of course, means the value of the stock in your account is going up, nothing to do with you, it's other people pushing up, and markdown is the converse. The value is going down, nothing to do with you, people are selling it. And then a stock will re-enter the accumulate phase of the cycle again. Now, again, that's idealized. You know, it's not like that's the perfect version of life, but it's not all that far off what you'll see. And you can measure these things. You'll have seen in our work that we use the Elliott wave and Fibonacci method for charts. Again, there's 101 ways to do charts, not claiming it's the best way, it's just the way it works for us. And very roughly, the theory of Elliott waves is stocks go up in a 5-wave cycle, right? 1 up, 2 down, 3 up, 4 down, 5 up. And they go down in a 3-wave cycle usually. You could also measure the amplitude of these moves, the amplitude, the price movement on the y-axis, and you can use so-called Fibonacci levels for that. We won't go into this today, but there are basically standard repeating type patterns that can illuminate a little bit what's going on with each stock. And so what you very often see is these accumulation phases take place around the bottom of a wave 2. A wave 2 is a deep sell-off. So that would be the COVID lows, for instance, in March, April 2020. It would be Q4 of 22 and early 23 in tech names. It would be after a really brutal sell-off. Markup. In our coverage universe, a lot of stocks are moving into the markup zone now. They've been down here at the lows. We've rated them at accumulate. You can see institutional volume has been coming in and buying them up. And now it's time to sit back, hold. We had a note out on Seeking Alpha, if any of you read that today, on Qualcomm. And we said this, we said, look, the stock can run up a lot. Probably it's time now for late buyers to come in. And if you'd been cute and buying earlier, then there's a good chance that you can sit back and let other people bid the value of your stock up. It's in the markup zone. One distribution opportunity will come at the top of a wave 3, another at the top of a wave 5, and then you can enter a likely markdowns. After the end of a wave 5 high, you're likely to see quite a big sell-off through the markdown phase and then back into accumulation. Okay, so this is the trade desk again on here. Now I'm going to switch, if I can, to a live chart. Just 1 second. Okay, here we go. So let me walk you through this chart method. And so just to refresh, we've considered in picking a tech stock, what sort of macro environment are we in? And we've decided that, well, right now we're probably in a supportive macro environment for tech. It's probable that rates are going to ease off, certainly grow less quickly, possibly flatten out, maybe come down. It is a fact that inflation is reducing, and it's also a fact that GDP is holding up pretty well. So right now you would say that's a supportive environment for tech. We looked at company fundamentals and we've decided that with TTD, we've decided it's got good fundamentals. It's growing quickly, it's got high gross margins, and it's got high cash flow margins. There are some weaknesses in TTD fundamentals, by the way, but we don't need to worry about those too much right now. And then we're going to look at the chart and we're going to say, well, where's a good place to buy in this chart and where's a good place to sell? With charts, it's always really good to get some historical context, and that's to get a feel for how the stock behaves over time and what sort of patterns it trades to, because very, very often, if you can identify the trading pattern, the price action that the stock respects, you can make some educated guesses about the future. They're only guesses, of course, but they're not blind guesses. They're not shooting from the hip. They are based on this historical performance. And again, these are never perfectly correct, but you can improve your odds considerably if you study the history and you've got a chart method that you found that works for you. This is a good example of Elliott wave and Fibonacci charting. So here we have a low that struck back here in the middle of 2018, bottom left of your screen right here. And the stock puts in a wave 1 up that peaks just before the COVID crisis, and then a wave 2 down, sharp sell-off, sells down to what's called the 61.8% retracement of this wave 1 up. It sounds fancy, but it isn't. It just dropped 62% of the value that was earned since this low. That's a characteristic wave 2 low. The stock then moves into a wave 3 up. And one of the ways you know it's a wave 3 is it's a big old move up and a quick move up as well. So at this wave 2 low, a couple of things happen. Number one, index options for the first quarter of 2020 expired, and so that was a heavily negative put-based set of index options because everyone was terrified and was selling the SPY, selling the NASDAQ, and so on and so forth. In the options world, which very much does move stocks. If you have a heavily negative, heavily put-based, particularly end of quarter for index options, what that means is that option dealers, market makers, have had to hedge that position by being heavily short stocks. They've sold you a put, so you're short, they've sold you that put, therefore they're long, and they hedge that exposure by being short stocks. When the put expires, be it in the money or not, they are suddenly in the market with a naked short position. These firms are not paid to take a position. They make money on the spread. They make money by being neutral, and so they rapidly cover those short positions, buy them back. And so that provided the ignition and the kindling for this wave 3 run up, which you see in almost all stocks. And then the accelerant came from the federal monetary easing, which has continued all the way through 20 and into 21. So you get this wave 3 up that peaked at almost the 3.236 Fibonacci extension of wave 1. And I can tell you that's a big, big extension. The S&P made it to the 1.618 extension, the NASDAQ to the 2.618 extension of its own chart, and TTD nearly the 3.236 extension. That's a big move up. What this is telling you is this is a really volatile stock, and that's not good, it's not bad, it just is what it is. And stocks that are volatile tend to be volatile for quite some time, and you can use that to your advantage. So you know that if a big move up is put in up to a certain fib level, then you can probably short the stock successfully if you want to. And if a big move down is put in that finds support at a key Fibonacci level, you can probably then go long the stock within a reasonable margin of error. After this wave 3 high, this is at the end of 2020, TTD then sells off actually pretty hard into early 21. So it drops from a split adjusted high of 97 down to 46. So it more than halves. And then it troughs at a key fib level of 0.618 extension, sorry, 0.618 retracement of this wave 3. That's again characteristic of a wave 4 in a volatile stock. We then get this final move up, wave 5, that peaks between the 61.8 and the 78.6 extension of waves 1 and 3 combined, which is a textbook place for a wave 5 to conclude. And those 5 waves form this big purple wave 1 up here. Characteristic of this charting method is it's people call it fractal. It's not really fractal, but what it is it repeats at smaller and smaller degrees. And so any 5 wave up cycle, you can say forms a large degree wave something, in this case a wave 1. So this here is the peak of the market at the end of 21. We then get the sell off into 22, as we know, and it drops all the way down to below actually the 61.8% retrace of this big wave 1 up here, about halfway to the 78.6. And again, that zone there, we've called it the accumulation zone here, is a characteristic wave 2 reversal. And so what we said in one of our subscription services, Growth Investor Pro, is that look, this is a good time to acquire down here because one, there's a low here at $39 a share, which has been tested all the way through 22, and it's held up. It was tested in May. It was tested in May again. It was tested in June, July. It was tested in November, and it held up every time. So that $39 level looked pretty unassailable, and so far it hasn't been broken. We figured that past that 61.8 retrace, we're into the markup zone. We're into late buyers coming in at that point. So we said, look, try and buy, between the 61.8 and the 78.6 retrace. So that's between $46 and $28 a share. Try to buy in that zone. And anyone that did has been well rewarded, because if you bought, the lows at $39, then the high so far for TTD was $59. So, you are up, what's that, 60, 70% very quickly. And even if you bought right at the top of this accumulation zone in $46, the stock's now at 51. So you're still 10% up, sort of worst case. We believe TTD is in this markup zone now. And we believe that what we're going to see next with TTD is this green wave 3 up. And we believe that that can run quite some way. Now, just to give you an idea of how far it could go, if we just sketch this out, a wave 3 will run to at least the prior wave 1 high. Remember, we're working the large degree here, the purple degree. So wave 3, if we're right, can run to at least 114, 115, up from the current 52. So that's 3 times your money right there if we're right, and there's every chance we are right. It could run further. So a characteristic level for a wave 3 to terminate is the 1.618 extension of wave 1, which would push TTD to 212. That sounds nuts now, it sounds crazy because it's been such a tough market lately. But we said earlier, it's a volatile stock. And the thing about volatile stocks is they drop through the floor, but they also go up a lot. That's what volatility is. Volatility doesn't mean bad, it just means it's unstable, it moves around a lot. And so if in, let me see, April 21, with TTD at 45, you'd said that by November, it could be at 113, then people would have laughed at you. But not people that did Fibonacci and wave charts. They'd say, yeah, okay, 61.8 extension of wave 1 plus 3 combined. Yeah, could happen. So we think that TTD can move up really nicely. The fundamentals are strong, the macro backdrop is strong, and the chart looks bullish. The question then, of course, is where would you exit? And the answer is, well, it depends on your personal time frame and risk appetite and so on and so forth. But if we're right here, then a good way to play this is to have bought the stock down in this accumulation zone here, which we would have flagged in our real-time services. And then as it moves up through this markup zone, think about risk management on the way up here. There's many ways to do it, of course. I personally quite like a trailing stop. So once the stock has moved up, if it's moved up successfully above my entry price, I like to use a trailing stop of 5% for non-volatiles, 10% more for a volatile name. So what that does is your broker system automatically notes the high point that it's moved to, and then if it drops by X%, which you define back from there, then they'll sell the stock. And it's just a way of locking in profits on the way up. You can always buy back in, of course. If you just want to buy and hold it, then in our house view, this could reach 115 in a year or two without too much trouble at all. And so at that point, we would probably be thinking about starting to take profits, because that would start to look like a distribution zone. And you'll see it because you'll see volume coming in at that level. We won't go through volume profiles on charts today, we'll do it another time, but you can see it happening. So distribution levels for institutions probably will be back up around these all-time highs. And the whole game with these charts and that wick-off cycle is try and basically invest like an institution does. Try not to shoot from the hip, as your average FinTwit bro will do, but try to invest much more like a grown-up. And that's the method that we're trying to use here. Okay, so that's TTD. So we've talked about macro backdrop for tech. We've picked an example. We've gone through what good looks like on fundamentals, picked an example of what good looks like on fundamentals, and we've looked at the chart at the time, entries and exits. And with that, that's what I plan to talk about today. So we can go over to questions if we have any. So I'll just make sure that everyone is unmuted. Yeah, my side. Yep. So anyone has any questions, do fire them out. And again, alternatively, you can always post them alongside the recording in the Substack note that we'll put out later on. Everyone's stunned into silence. Excellent. Okay, well, it remains for me to thank everyone for being, oh, hang on. Sridhar, you've got your mic open?
Yeah, hi. I think, so thank you for walking us through the Elite Wave charts, but this is a pattern, right? And there can be super other patterns that can be presenting themselves, which may or may not follow the clean 5-wave that you have exhibited.
Of course, absolutely, yes.
In that case, what are your thoughts on entry and exits?
On what, sorry?
What are your opinions on entry and exits?
Well, unchanged really, which is,
okay.
You have to find, I mean, this is hard, right? If this was easy, everyone would be zillionaires, and they're not. You have to find a method. So fundamentals are fundamentals; they're facts, right? And so that's just a question of learning what good looks like, and then learning to read a set of accounts, or subscribing to a service like ours, where somebody else does it for you, but they're facts. That's not really up for debate. Good is good and bad is bad, right? Charts, of course, are completely subject to interpretation, and you know, the best technical analyst gets things wrong all the time. You know, the best trader gets things wrong all the time. So how do you reduce your chances of being wrong? Number one, you have to find a system that works for you, that you like, that you find intuitive to use. Now, personally, you know, I like this method and I find it works for us a lot, but that's just me personally. And the reason that I like it, by the way, is that I never, ever, ever could figure out when a stock was overstretched and therefore when to sell. And I also could never work out if a stock was at an all-time high, was it a good idea to buy it or not? And I couldn't ever find the answer to that until I discovered these Fibonacci tools. The wave method is an interesting overlay, but the real actual measurement, these Fibonacci levels, and they're not really voodoo. They're you know, they work because algorithmic trading uses them. Basically, all you're doing is using the language of a professional trading system.
Right.
And so I like this method, but other people use different methods: Bollinger Bands, Keltner channels, you know, parallel channels. I mean, there's a million different things, and very often you'll find that they coincide, that the conclusions that each method reaches coincide, you know, for various reasons. Because ultimately, what any of these methods are doing is you're trying to deduce what is it that big account players are doing with this stock. That's all you're ever trying to look at, and you've got a murky, musty lens that you can barely see through. You're trying to look through your dusty magnifying glass to see what are big account players doing with this stock or this ETF or whatever it might be. And so once you've found a chart method that works for you, use it. And again, I like this method. It works for me. It works in our services, but there's many others. Frankly, you can also look at the option market and see what the option market is telling you about where a stock's going to move to. That's another good method. There's lots of ways to do it, but you have to find a way that suits you. And what I like is one that is unspecific to any one particular stock, right? I like a chart system where you can pick a stock that you know nothing about, nothing at all about, and look purely at the chart and go, best guess, I think this is where the stock's going to go. The other thing I like is where you can identify high risk reward opportunities. So these accumulation zones we use. So I'm just going to switch back to this chart screen. Hold on. We like them for a couple of reasons. One, we think that it's when a stock is depressed and there's plenty of upside, but as importantly, it's when we think that there's downside protection close at hand. So if you know, one was buying TTD in the low 40s down here, you know that a good place to place a stop is in the mid 30s, right? Because this $39 had been such strong support. So if you're buying at, I don't know, 42, 43, and you've got to stop at 36, 35, if the stop trips, you're not going to suddenly get a massive hole blown in your account. You get a small hole blown, but that's what a stop is for, so it might stop it getting worse. But what you won't get is, well, hang on a minute, I've just lost half the money I put into it because I thought I'd set a low risk stop. Oh dear, it's hit it and it's cost me half my stake. You've got approximate stop and a big run up potential ahead of you. So that's the other reason I like the system. It helps you with risk management. But as again, there's many ways to do it.
Okay, thanks for the clarification.
No, you're welcome. No, thanks for that. Thanks. A great question. Thank you. Anyone else? Again, please don't not ask something because you think it isn't a sensible question or you think somebody else will have the question. The fantastic example, the question just given, so do ask anything. And again, if you prefer not to use audio or you can't for some reason, do post on the Substack note where the recording will be in a couple of hours' time. Okay, folks, well, thank you for attending and thanks for subscribing to our Cestrian Tech Select Substack. It's much appreciated. That newsletter has gone from strength to strength in the last 12 months or so. If you are a free reader, thank you. Consider stepping up to either the premium or the pro tiers. You'll find them, I think, to be really good value. You can find details on the Substack page. So thanks for attending, everyone. Posting the recording of this in the system in a few hours' time once it's compiled, and we'll see you soon. Thanks a lot.